Alicia, well, markets certainly taking heart from new developments in Greece, with European Union finance ministers now willing to put their hands in their pockets to finance a €30 billion emergency loan if needed. We also have strong commodity prices propping up resources shares and the rand. Joining us for his take on all of this is Mike Estment. He's the CEO of NFB Financial Services Group. Good afternoon, Mike. Can't get that out. How are you today? Good weekend. Mike, I mean, there has been talk of a double-dip recession, of a big pullback on the markets. Is that starting to fade now? Do you think it's just onward or upward, or do we still run risks?
Yeah, I think there's a big case for the result for earnings improving, being the cutting of costs rather than the generation of massive income from a browbeaten and beaten up retail investor who's the guy that actually ends up spending the money. However, having said that, the politicians having got together and made a deal that suits their constituencies, whether that or not is true will come out in the next couple of months, but Greece is being rescued, and that's a very substantial show of confidence, and that underpins markets. It's all about confidence, and if the system is prepared to back itself, that's a good sign.
Of course, we do know that Greece is just the tip of the iceberg. We have problems with other southern European countries as well, and of course Greece can borrow all this money, but it still has to pay it back at some stage, and estate financing costs are going to shoot up with these loans. So it's not out of the woods yet. We still have some way to go, don't we, Mike?
Well, they call it Club Med, where you've got Italy and Greece and Spain and Portugal and so forth that have got economies that are quite heavily dislocated from the core Central European economies, and a massive dislocation in their productivity. They don't have independent currencies that they can depreciate anymore, so it's one for all and all for one. They had to come up with a deal. But you're quite right that borrowing costs, it's not just having to repay, it's about having markets that are willing to up the ante, put the money on the table, and if the countries that have got the cash, that are cash positive, the Arab countries, the East, wants to, it can obviously put the price of money up substantially and saying, well, we'll buy it, but at a price that suits us.
Of course, Club Med a bit more flattering than the pigs, which is what they previously called them. US earnings season starting today on the other side of the Atlantic, and of course I think all eyes are going to be on those US earnings. Alcoa kicking it off today. What are investors going to be looking for in the upcoming results season?
Well, I guess there are two parts to that. The spin doctors are going to try and put the positive spin on the results, and the investors looking for it. The professional investors will be looking way down the line and to sort of see, well, back a while and forward to see whether there's sustainability there, because that's what you're buying. If you're making an investment, it's not an investment to try and job the market and get in and out. If you're a serious investor, you want proof in the numbers and in the communication from the companies that what is delivered is better than you hoped, and is sustainably going to improve in the coming period.
But then, of course, if you are a serious investor and you are in it for the long haul, you won't really react to just small blips that might come out in the results season, would you?
I think there's been lots of room for people to, because the season and the earnings pattern in the last while has been so poor, to get information out there, to get rid of, to empty the cupboard, so to speak, and in the closet of any skeletons. Hopefully those are banked and out, and there can be sustainable improvement going forward.
Of course, with the rise we've seen in equity markets over the past week or so, and of course commodity prices, we've also seen the rand strengthening and continuing to defy gravity. Of course, the strong rand, how do you work that into your investment policy? How are you viewing it at the moment? Because there have been economists calling for it to weaken as we head into the latter part of the year. Should you be taking advantage of the strong rand now then?
Well, taking advantage of the strong rand can be done in a number of ways. Firstly, the Reserve Bank eased up on foreign investment allowances last year, and an individual, effectively, most individuals in South Africa de facto do not have any exchange controls anymore, although there are rules and macro constraints for the individual, because these numbers are so large, those constraints don't exist anymore. The funny thing is that once that happens, the individuals then get a bit lackadaisical and sort of say, well, when it gets to, and because the trend is positive, they'll probably now say, well, when it gets to R6.50, because around the dinner table, 1 year's of R6 and R6.50s and World Cup's coming. But that's a month in the history of our country. the macro, the longer term picture is that the rand is probably in a seasonally very strong position. It's backing a sort of a long-term trend, and trends are your friend, they say in the market. So probably diversification, which is an old theme that I've shared with you countless times, it is a good idea to take advantage. And it doesn't mean to say that if you have 2 million rands or a 1 million rand investment that you have to do it all in one shot. To aggregate that out over the next 6 to 12 months would make sense.
Well, where would you be advising clients to take that money?
Well, that's a very good question, and again, the big deal is if you've got the East and not just China, but the East and these and the BRIC type economies developing and growing at 5 or 6%, whilst America and the UK and Europe, who are traditional destinations for foreign flows, are struggling and will continue to struggle because they've got to repay all this incredible debt. Is probably the 5% growth rate in those BRIC countries. They're going to become a much greater and more material beneficiary from not just countries like ourselves where people want to diversify, but from the developed investment manager, the developed countries investment managers. So the American guys, the European and UK guys will take those BRIC countries much more seriously, and they'll probably get better allocations of portfolios from an old 5% 5 years ago to probably 10, 15, even 20%, and I think maybe even more in years to come.
How about investment coming back to South Africa? Because of course you were talking about emerging markets being attractive because of the growth rates at the moment. Of course we do have some uncertainty on the political front in South Africa at the moment. A few events over the past week. Do you think that's a distraction for foreign investors?
I think foreign investors can be fickle. I think foreign investors, however, have shown enormous confidence very quickly after the world's probably greatest economic crisis to extend themselves back into emerging markets. At a retail level, I think that events will impact. At a tourism level, they could. I think that, as your previous guests mentioned, or in fact the Nedbank currency guys mentioned, that the government seemed to be acting appropriately and containing certain sort of outbursts and actions. If that didn't happen, then you could have an institutional flow through as well, because the institutional investors have done really well on our currency. They've done extraordinarily well on our market in the correction, and they are able very quickly, just as they've loaded 70 billion onto ZAR, they could unload it or part of it, and that could be very, very impactful on the currency in the short term.